What's up, you guys? Here we are for another episode of the SnapRefund Podcast. I am so excited. We have an amazing guest for you all here, a long-term friend of mine, someone that I've seen grown firsthand into stardom in the insurance industry, absolutely killing it right now. In this episode, we're going to sit down with Valkyrie Holmes. Now, over the last 5 years, we've seen more than $100 billion disasters across the US. And those aren't slowing down, unfortunately. But what if we can actually predict which homes are more likely to survive these catastrophes? Well, today we're joined by Valkyrie Holmes, the CEO and co-founder of FORA, a company using data to help insurers validate, mitigate, and build smarter portfolios around resilience. Valkyrie's background spans tech, insurance, and entrepreneurship, and her mission is simple: to help reduce risk in high-risk insurance. We're diving into how FORA is reshaping the future of catastrophe modeling, risk validation, and what resilient insurance really looks like in 2025. So without further ado, Valkyrie, please welcome to the SnapRefund Podcast.
Thank you, guys. Very excited to be here.
We're excited to have you. Well, starting off, what inspired you to launch FORA and why focus specifically on high-risk insurance?
We started FORA over 3 years ago now, and we landed on insurance after pivoting around in a bunch of different areas that were pretty legacy. So we were working with community organizations, things like Firewise councils, different grant organizations and programs around California, and realized that we were running into a couple different barriers, and those could be boiled down to cost and education. So a lot of the programs we were working with either had really great educational resources and couldn't really link the cost benefit to them, or had the cost benefit, but people didn't really know what to do to get a hold of that and actually create that incentive. So we approached insurance kind of after picking things around and trying a bunch of different things, because it kept coming up in conversation as something that everyone relies on, but also a lot of people are struggling with, especially in higher risk areas. So the decision to focus on insurance was purely because of that kind of incentive mechanism that matched the ability for us to give people education because they're thinking about their risk every year, but then also the cost benefit of you pay a premium every year and that can be reevaluated with discounts and so on. I think the high risk insurance piece was really just stemming from my love of research and natural disasters. I got a grant to pursue climate research and got really obsessed with the idea that wildfires are actually really healthy for the forest, but we have been putting them out for so long that now all of these communities that are built in forests are surrounded by dead fuel in hotter, drier seasons, and it just creates this whole storm of different effects that end up, having really disastrous consequences like what happened earlier this year. I think the focus on how do we get programs in insurance to help people that are in these areas, I think it is a necessary piece of building community around this idea of mitigating risk, if that makes sense.
Yeah, it absolutely makes sense. And it's really special that you're doing something like this, especially for high risk insurance, right? So tell me a little bit about your background and how did that prepare you to bridge the gap really between building science and insurance and technology?
Well, I have a slightly more unconventional background, I think, now coming into insurance. I like to say that I came into insurance, I fell into insurance like a lot of people, but I got to ask all of the really dumb questions about why we do the things that we do purely because I wasn't coming from inside of the industry. My background stems a lot from traditional data science, and I spent my early career in space tech. So it was something I was obsessed with from a pretty young age. I interned for the NASA Seas Institute and then got a position at SpaceX on their commercial rideshare team. So basically the team that was designing the payload for Falcon. So we were helping companies basically measure what they needed to measure to get in space. And while I was working at SpaceX, I found out about this program called 776 that was a specific fellowship that was aimed at young people that wanted to build something in climate. And they made it pretty open-ended. It was, you could do advocacy, nonprofit work, for-profit, startup type things. But the big caveat was that you couldn't be working and you couldn't be in school. I had already left school to work for SpaceX at the time, so I decided, hey, I can always come back to SpaceX. Maybe I try something on my own. And I also recognize that I say something like that, and that's a very scary thing for a lot of people to take that leap. But I'll mention that it was de-risked for me as a result of being around a lot of friends that had done startups and had been decently successful with it and that was like the catalyst for me wanting to do something on my own. So that's kind of like the big part. And then over the course of that grant, I started learning more and more about the engineering behind how buildings are made and what helps people survive and not survive. There's like specific resilience criteria that a lot of people have done research on. People talk about IBHS all the time, so they do fantastic work. And then at that point, it was just about finding a place for it, and then finding an insurance. And again, I'm still learning so much. It is like a very, I feel like it's like a big joke that like I am like a baby in insurance right now, but I'll gladly take it because that still gives me some ability to ask potentially stupid questions. Now people take me seriously still, so it's good.
Well, your work speaks for itself, and everyone has to start on this journey somewhere. So being humble and honest about where you start from, I think is really the best way to get as far as you can in as little time as possible. And you and so many others in this space are good examples of that. You touched on something really interesting. And this is one of the core questions that I like to learn about when it comes to models like yours is because you are essentially putting your blessing on this idea of a home is more or less survivable based on these criteria. What data inputs are you using to actually validate the truthfulness of that? And also specifically, what source of truth really powers it all at the end of the day? Do you have in-house expertise that's able to rate the survivability of a home based on certain criteria? Or are you trusting some third-party data source to provide that kind of context?
Yeah, all great questions. I'll zoom out and kind of just talk about the context of how we built our survivability models. At a high level, it's essentially a combination of subcomponents at the structure and parcel level. So when we were initially thinking about insurance and we were seeing all of this evidence, especially after, the really famous photo of Lahaina, there's been other examples throughout, like very famous, like wildfire and hurricane prone areas of properties that are the only one on their block to survive, the only one in their neighborhood still standing. And, we start to ask the question of, okay, well, all of these models that are traditional hazard models are telling us that these properties are high risk, but there are properties that are outside of that defy all odds. So first is answering the question of, well, is that just kind of a fluke or is there actual like science behind that? And it turns out that if we really analyze the individual subcomponents of how properties are built and maintained, then that helps us weight different categories to the point where we can get the survivability index. So that's essentially what we've done is we've taken all these properties over the last, give or take 100 years, depending on the disaster, and we've taken the ones that have survived, haven't survived, the reason for how they have survived or not, and then weighted them according to how they fared historically. So that gives us a score from 0 to 100, 100 being the most resilient a property can possibly be. That tells us, essentially quantifies the level of resilience on each individual parcel or structure. And that does a couple of things. The first piece, and then kind of touching on another piece you talked about in terms of like data sources and validating that information. The first thing it allows us to do is give underwriters a sense of, okay, for this specific property, maybe a disaster is likely to happen here, but if this property is mitigated, it could potentially still be a very profitable risk for us to identify. So it's opening new potential markets for people that may have otherwise completely ignored zip codes or even entire counties. And then the other piece of that is it's helping the policyholder actually learn about their property. So the survivability piece is one angle that we've taken. The other angle is being able to have homeowners submit information about their property and their mitigation in order to give us better insight about how their property can survive. So if I ask you, Cody, and we say, hey, your property is a 55 on our score, we recommend that you do these specific action items. And you tell me, hey, I've actually done 2 out of the 3 action items that you're suggesting here. We provide a very easy way for homeowners to say, hey, I've done this work. Here's what I qualify for in terms of discounts or incentives. And then we give that back to the insurer to tell them this is a more profitable risk. These are people that are likely to do this work and maintain their risk. And it kind of paints a picture of resilience in a way that I don't think we've really crafted yet or haven't had to craft until we've experienced so many continuous losses. So I think the last thing I'll say on that is we use a combination of public and private providers. We're like pretty much every company in insurance, we are somewhat reliant on public data. But I think a big piece of how we're growing and why this is so important is the more of the combination we have in terms of using public data to verify property information and giving homeowners the ability to correct us. It gives us more touch points and the ability to make it much easier for us to see which properties are actually survivable or not, if that makes sense.
Oh, that makes a ton of sense. And it's really interesting the data inputs that you guys are using just to model out your predictions with that. So I think that's the part that's the most fascinating. But as you're doing that, really, it sounds like the tech is proprietary. Maybe you could tell me a little bit more if it's proprietary technology that you guys are using. And how do you balance transparency with the proprietary tech that you guys are using when working with carriers?
Yeah, it's honestly a really good question that I wish more startups touched on. And, I think the first thing that I'll say here is we, at the end of the day, are not an AI company. I know AI is like a really big fundamental piece of what everyone is talking about nowadays, but we purposely kind of skewed away from calling ourselves an AI company, making all of our tools like super AI heavy because of this transparency piece. So I think when you're starting a company, it's already one thing to take something that people are relying on and make it better, make it more efficient. And something that we're trying to do in addition to that is something that I don't think the insurance industry has really seen before, which is also like a hurdle in and of itself, right? And you guys know that as well. So many hoops as we can like limit us having to jump through, including the black box AI questions and challenge. That's kind of what we tried to avoid with that. So I think we inherently have an easier time with that. And then I think, our model is proprietary. We have a good amount of like data to show us that, that the model works and that we can show people, this is our kind of results in the past. But I think the big part of why I'm not as worried about the transparency piece is because we're pretty transparent overall in terms of like what goes into a property survival anyways. And even with that, even in the last few years, we're aware that people are developing models that like might be slightly similar to us, but the data speaks for itself. That's kind of what I'm saying. And so there's a lot of conversation in the startup space about when you start a company and when you have an idea, maybe you don't want to tell anyone because you're afraid that people will steal your idea. But there's so many people that don't steal ideas that like don't even know how to execute them. And at the end of the day, it's like about execution. So as long as I can balance telling people kind of like at a baseline what goes into this model and then developing an experience that keeps it as sticky as possible, I think that's really what we're aiming for. And it's like about the value at the end of the day. So I'm never really worried about if our proprietary tech is going to be copied because at the end of the day, if it's a good idea, people are going to copy it. And that's kind of a good market signal for us anyways.
Yeah, you're absolutely right about that. I think there's a lot of learning. There's stages of growth for an entrepreneur. And I found myself in the earlier stage with a niece, some years back, where before we were talking to people, I was like, they got to sign an NDA, like this idea,
Hmm.
can't get out there because someone might try to copy it. But the truth is, ideas are a dime a dozen. It really is execution that matters. So hearing you echo that, I think shows your growth in this space because the truth is, especially in today's era, copying apps is really easy. Anyone can go copy Netflix or, you know, Twitter. It doesn't really matter because coding it is easy. It's the distribution and the BD that actually makes it something valuable. So on that note, what kind of ROI do carriers see from prioritizing these resilient properties through FORA?
Yeah, so there's a couple things that I'd love to kind of touch on there. And when we talk about FORA, we separate it into two kind of different buckets. The first one is that property survivability portion and that model that we talked about. But then the other part is kind of touching on what you just said, like the distribution and consumer engagement piece of it too. So when we got into the space, so many people told us, don't do insurance and don't do consumer insurance because it's really hard. It's a really hard problem. And a lot of carriers at the end of the day struggle to maintain customer engagement, find these new customer touch points where people will interact with their carrier and give them better information about how their policy is reflected in their day to day. And so I acknowledge that that problem is really hard. And we're still every day trying to like make it easier for people to understand and gain value from it. But in terms of ROI that people are now experiencing, we have separated it into a couple of different things. So we have our quick assessment, which is all a carrier has to do is just ping us with an address, and then we return the resilience score to them. So it's like you would ping any other traditional hazard model based off of the address. And from that, again, I kind of touched on it before, but it was underwriters can now spot more resilient properties in areas where they might have completely not underwritten anything. So they're unlocking new potential business in these areas. They're also often able to, at renewal, to select more people to give them additional information that unlocks business. So what I mean by that is homeowners can do a walkthrough of their property, They answer questions, they take a few photos and videos, and then we're able to synthesize that into a more qualified resilience score that proves to an underwriter, hey, they are doing this work, they're a more profitable consumer, you should still be offering them a policy, even if maybe previously you wouldn't have been able to. There's the premium increase, there's the retention benefit, which I think is hard to quantify in some areas, but we're quantifying that in terms of not only like open rate and engagement, but also how many people after renewal interact with us and stay with their carrier versus the average number that interact at renewal and then leave or go shopping around somewhere else. So what we found is if we can get even 2% of consumers to interact with an assessment, then we're much more likely to get people to stay with their consumer or stay with their carrier and gain more benefit from the fact that they are getting these resources and doing these action items and qualifying for discounts. So really, it's a very small percentage that we have to interact with that proves out the overall value for the carrier. And something we're working on right now as well is just the ease of use for someone when have done work on their property. Even just this week, I've gotten 5 separate people to tell me, about their experience with living a home or putting a new roof on their property and trying to report that to their insurance company. And right now in the US, there's a little over half, around 52% of EU people in the US have reported doing some kind of major home renovation in the last 2 years. But only 38% of the US knows to even report any kind of renovation to their insurance company. So there's a huge gap in people that don't understand that they have to report these renovations. And of the people I talk to that are in insurance that know they have to be reporting these things, it's a really convoluted process to be able to do that, even though they are technically doing work that insurance companies should want to know about. So I think we're still trying to quantify the ROI in terms of like time savings and like efficiency that can be gained there. It removes a lot of like the back and forth of customer service and success agents having to verify that people have done this work. But that's something that we're really excited about that I think will be just another step in like cracking the consumer piece to a lot of insurance carriers.
So then let me ask you this. How do the brokers and policyholders, how have they been responding to the concept of your resilience scoring?
Yeah, so the broker piece is something that we started exploring in the last half of this year, and it was interesting because we went through the Lloyd's Lab program this summer and talked to a lot of brokers in the Lloyd's market, and what they consistently kept telling us is if policyholders are getting this resilience score and carriers are using this resilience score, and me as a broker, like I have no idea where this is coming from, then it paints this picture of, that there's a big like education gap and also like a lot of work that could be done from the broker side to further educate and reinforce this mitigation work for a homeowner. So for brokers, we've kind of approached it from our broker platform that we released a couple months ago, where they're using it for either prospecting. So if I have 100 leads and I know that 40 of them are going to be the most resilient and I want to put those in my preferred markets versus maybe the other 60 are going to go to more specialty providers, then that helps me kind of triage in a more succinct way. And then also just be a better risk manager. So if I have someone that's ranking on our scale as like a 35, which is kind of in like the lower quadrant of what we're dealing with, and I know that if they do 3 things to reduce the risk on their property, I can get them from a 35 to a 45 and then maybe a 55, then that, increase of mitigation over the next like 12, 18, 24 months makes them a better risk and ultimately makes it easier for them to get insurance or get lower rates. So it's a better experience. Policyholders, I think, is a unique case because in most cases they're not getting a lot of communication from their carrier. So we are now starting to be kind of like the first new customer touch point in a lot of cases, which is exciting, but also there's a lot of tweaking that has to go on from our side in terms of like behavioral psychology of what people interact with and what they want to see most from their carrier. So for example, we've been playing around with the tool as like an additional entry point for policyholders where, let's say 3 or 4 months before your renewal comes up, we send you a letter that's white labeled as your carrier that says, Anise, this is your wildfire resilience report. You're a homeowner in California in a wildfire prone area. Your score is a 57, but your neighbor's score on average is a 68. So now all of a sudden you have this comparison metric that says that gets you starting to ask questions like, why am I a 47? Well, what does that mean? Like, what do I do about it? And so then on the next page, it shows you, okay, here's some action items and things you could do to improve your score. And if you've already done this work, here's a simple QR code that you can scan that helps you get to that point, and really submit it to your insurance company, making it easier, like I said, to make it apparent that you've done it. And I think that's been like a really interesting test case, and we're starting to see a lot of good feedback from it that involves people in the process, that creates some urgency. It's like before their renewal, so they can directly see any benefits reflected in their policy statement the next month. And there's still some tweaks about that going on. The differentiation between maybe people that just bought a new home versus have a family versus our older population, I think there's different nuances there, but that's kind of like the response that I'm gauging interest in. And it's been pretty interesting to see the differences.
So as we look at not only the carrier impact and the impact for brokers of placing new coverage, but the actual policyholders, is there a reduction in rates that policyholders benefit from? It's clear that they might benefit from their house not being burned up in a wildfire. Like that's obvious benefit for them. But are the carriers actually conferring the advantages of greater profitability back to the policyholder in some financial way?
Yeah, I think it's something transparently that we as an industry have to get better at. I think the communication around incentives needs to get better. And I think the good news is that we're already seeing it start to shift. That's something that we are actively capitalizing on because it benefits consumers actively right now. So an example for that is in California, in Colorado, or let's just take Colorado, for example, they passed this new wildfire risk modeling act that we've been getting a lot of questions about that revolves around transparency for the consumer. So if you're using a wildfire score in Colorado, you have to be able to tell a policyholder within a certain time frame, this is what your score is, here's what it means, here's what you can do if you want to improve that score, all within basically that like binding period or that renewal period before they send out the new notice. It's been kind of a shock to some companies to receive something like that when I think we've had certain discounts that companies have filed and there's been talk of, reducing rates if people have like IBHS standards. We love IBHS, no shade at all. But at the end of the day, we need to make it easier for people to tie these incentives back to their carrier. And there's still a lot of carriers that have this association with IBHS that don't yet accept IBHS discounts or IBHS certification. And that's just one small part of the underwriting process that we need to make more transparent in terms of like what is actually guaranteed. So one of my big goals for the next year and hopefully for the rest of the time that we're running FORA is to be talking to regulators and consumer groups and also carriers to see what is the optimal range of discounts and incentives we can get to not only I understand that there's a bottom line involved for carriers that want to be writing in these higher risk areas, but also if consumers are being better retained because we're giving them this information and they're doing this work, ultimately they are a more profitable risk. And it's about finding that top 10% of like quote unquote right customer centricity method of rewarding people that are inherently better for business. So I think like TLDR, it's still a big concept that we have to wrap our heads around. It's moving in the right direction, especially in California and like West Coast. But for now, it's going to be largely customized depending on what the carrier is willing to include for their policyholders.
Valkyrie, as I listen to you, and I've told you this often, I mean, you're brilliant. And what you've built with FORA and your team, really it is ahead of its time. So being on the cusp of what's happening in the future, I'd love to get your point of view with how do you see climate risk and resilience really shaping the next decade of InsurTech?
Well, going back to what I said before about just the fact that like we're seeing people pop up that have similar mindsets around resilience and insurance. When we first started FORA, we were told by, some investors, some people in the industry that if this continues to take off, we're going to get copycats. And sure enough, every month or so, there's someone else that comes onto the scene. And honestly, I love it. I think that like we've had a decade of really intense conversation around climate risk. I think the first half of that decade was them saying, oh, like this is a real tragedy that this happened, but we're going to bounce back. And then it keeps happening year over year over year. And then now the last half of the conversation has been, oh crap, maybe we aren't as prepared as we are. And it's been a lot of panic, trying to figure out what the actual solution is. And I'm not going to sit here and say that our solution is the best solution for everything and that like quantifying resilience is going to be the be all end all for climate risk in insurtech. But I do think that if specifically if insurtech companies can start asking better questions about why we do the things that we do, if people from outside of the industry can come in or people with industry knowledge that have this outside perspective or experience can recognize that and say there's something new that we need to bring to the table. I think climate is one of the like biggest industries that's ripe for innovation. So we see that in this ton of parametric companies that are popping up, and there's a ton of people that are doing really well there. Wes at Sola, Adaptive, Mike Gola, their parametric electrical solution. So I see a ton of like really great movement there. And I think the more that we see that, the more that we almost give permission to executives and people in insurance that aren't in insurtech necessarily to start asking better questions that aren't just like status quo, like why are we doing the things we're doing? So yeah, I'm excited personally.
Yeah, me too. Shout out Adaptive. Great team over at Adaptive. We love the work they're doing.
Yeah.
We're super excited to be along with the journey. So, what advice would you give other entrepreneurs who want to build not only good solutions in this space, but mission driven businesses in the insurance space?
I mean, I will never sugarcoat it when I say that, building an insurance is hard. Building a mission driven company, I would argue, is harder. And that might seem crazy to to a lot of people that have been in insurance for a while, but I constantly ask myself these questions because my boyfriend, he's also a startup founder. He's in the compliance finance space, and we talk all the time about the fact that his company is taking this process and automating a process that currently exists. But in a lot of cases in insurance, we've done things the same way for so long that it's really hard to break out of that first off. So, and that's what makes an insurance tech extremely difficult. It's all the things people talk about. It's the long sales cycles. It's the relationship building, but then it's also just driving adoption, and enterprise adoption is really, really difficult. So we still struggle with that all the time. But I think then like building a mission driven company, especially when it is a little bit slower and it's an industry that is slightly more resistant to change. I've even seen it in myself, and I'm glad I have like my co-founder Amanda is just so grounded in her belief in this consumer product that like she's had to tether me down and say like at the end of the day, like we're building this, we're in insurance because of this mission. So like I think it's up to me and it's up to other founders to just like share their general experience. And I have no problem telling people exactly what I've experienced day to day. And at the end of the day, I get people need to play the game, right? Like I play the game in this industry all the time. So it's just up to me to like give people all of the perspective and notes that I have so that they can make more educated decisions. And that's the advice that I would give is people inherently are good and want you to succeed. So lean on people if you want feedback, if you want to ask them questions, if you want to, literally just this week, I've been calling up a bunch of people with this new concept we're piloting. And hey, do you have like 5 or 10 minutes of time? I would love to run things by you. And 9 times out of 10, I would say 99 times out of 100, people are more than willing to give you that time. So that's the biggest piece. And then the other piece is just having good people around you, which is like a cliche, but it really is true. I largely underestimated the value of mentors and advisors and people that you can just bounce ideas off of that are non-biased, that are just like enjoying the work that you do and enjoying the industry and like the problems to solve. And I think a bit of that is an ego thing. I think a lot of startup founders are like, this is the way to solve the problem. And I'm just like tunnel vision trying to solve it. And that has been me for most of this time. It's only this year that I really like given into this idea of getting help from people all over and having that consistent community behind it. But then I look back and I'm like, yeah, I would be nowhere near where we are if it wasn't for me just calling up Curtis and Meredith and Rose and all these people that somehow like us and like what we're doing and we're willing to give their time. We wouldn't be anywhere near where we are without them. So that's the biggest thing, is just rely on people at the early stages to tell you what's wrong and give you advice. And I think it'll go a long way, further than you think. So
I think that's great advice. And shout out to Curtis and Meredith and Rose. I mean, really, this space is such a wonderful space. And that's been one of the things that we found a lot of value is just the community. Once you're really in it, how people lean on each other and really help each other the best that they can. And getting and asking advice for feedback is always one of those places where you can get some great value. So, what's next for FARA? Any new partnerships, products, or predictions that you can share?
Yeah, so I mean, we're ending off the year strong. We are working with a couple like national brokerages now, and starting to build out more of this like broker channel. I think something new that we've been working on is kind of that report aspect. A few months before renewal, you get this letter, and it helps compare a lot of like traditional consumer behavior, almost like one of those like energy or water utility bills that you get in the mail. A part of that is to, especially going into wildfire season and a lot of the, natural disaster prone seasons kind of coming up here, that's something that we're really excited to test. And we're running a bunch of little experiments on it now. So hopefully that will be kind of what 2026 is about in terms of adoption. But yeah, I mean, there's a lot of like potential arenas for us to go down, but I hope that we continue gaining some partnerships. We've had like a great year in terms of more distribution partners as well. So hoping for more of that. And I think it'll just be a good end to the year, which I'm excited about.
Well, I see you've got the Christmas tree behind you. Looks like you're already ready for the year end. So it's coming in strong. Hopefully it's been an amazing year for all of our listeners too. We thank you all so much. This is going to be one of the last episodes of the year, actually. So Valkyrie, thank you for bringing us into 2026 properly. It's always appreciated. Everyone, my name's Cody Eddings.
And I'm Anise Taylor.
And this has been another episode of the SnapRefund Podcast. Peace.
Peace.